you basically add equity curve for strategies. You keep adding equity curves, and you look at your kind of risk-adjusted return. And what you find, if you trade one strategy, you're going to have a lot of risk. But if you trade two strategies, your risk comes down, and it's kind of like almost like an exponential curve going down. And then once you get around, depending on your strategies, roughly around 20 to 30 strategies, the benefit of adding another strategy to your overall risk performance or your risk adjusted performance isn't that great.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
So, not that we know necessarily exactly all the nuances of what Bob Pardo is doing with his walk forward, but do you know if you do things differently to him, or do you have a particular approach to walk forward analysis?
I do. And the reason I know this is because I'd been doing walk forward for a number of years. And actually, when I won trading contests way back when, I was doing walk forward. And then at one point, I decided to read his book on walk forward. And even though I had success up to that point, I was looking for, hey, maybe there's something new here. And that book was an eye-opener because I found out all the things I was doing wrong.
Yeah, right.
And still succeeding, because he said, well, only, I'm paraphrasing, but he basically said, only an idiot does this.
Yeah.
And I'm like, oh, that should have my picture in the book, because that's exactly what I've done. And I still do. So I think we do things. Yeah, we both do walk forward testing, but I'm sure the details are totally different. And hey, if it works for him, great. If it works for me, great. There's other traders out there who I highly respect who don't do walk forward testing at all. They think it's a joke, or it's ridiculous, it's superfluous, whatever. And some of these guys I get into, not arguments, but kind of playful teasing of, hey, I do walk forward, you don't, I'm better, you're worse, that kind of thing. But ultimately, if it works for the person doing it, who am I to say? I can only do what's worked for me, and you've got to do what works for you.
Are there some, non-proprietary kind of principles you can share with what you are doing with the walk forward? Is there something specific?
I think the fact that I do the test once and don't go back and change the strategy and do it again, I think that's a big one. I think a lot of people, it's either people talk about walk forward testing, they might not necessarily say that. Some people probably do, but some people probably say it's okay to retest. But that's when I've found that's you do it once, okay, that's where you should be. But if you test something twice, now you're starting to go down this slippery slope, and then you do 2, 3, 4, 5, and it gets steeper and steeper, and all of a sudden you've got this head of steam of just going in the wrong direction. So that's part of it. That's one thing I do. The other thing that really bothers me is, I'll give you a little backstory. I was doing walk forward analysis before a lot of the trading software offered it. So I was doing walk forward before TradeStation. So, for example, before they had it, and I've been using TradeStation 20 some years. And then what they did was they bought a third-party tool that did walk forward testing. They hired the guy who built it. They had him move to Florida to integrate it into their platform. And the most interesting thing they did with it was something they called cluster analysis, where with walk forward testing, you have this in sample period. That's your test period that you optimize over. And then you have your out of sample period where you evaluate the strategy. And it can be anything you want, both of those. It could be 1 year, 6 months, 1 year in, 6 months out. It could be 2 years in, 6 months out. It could be 2 years in, 1 year out. Whole big array. And what TradeStation did when they released it, they did something called cluster analysis, where they examined a whole matrix of those combinations. Okay. And then they determined through some algorithm, I don't even know, some criteria, that one spot, one particular value was the best. Okay. And that's the one you had to use. And when it came out, people were like, "Oh, thank you, TradeStation. I've always wondered how this worked, and you've solved it."
Mm-hmm.
And I remember just shaking my head. I'm like, "Oh my gosh! All they did was just optimized for the best one." And then if you go and use that and validate it, you're validating it on the exact same data that you just said was the best, where it was the best. And what's going to happen? It's going to say, "Oh yeah, that's pretty good." And so people were running that second test thinking, "Well, I just validated what TradeStation told me." I'm like, "No, you you just validated an optimized test." And that went on for, I want to say, about 6 months, because that, I'd monitor the TradeStation forums where people were like, "This is so great." And I tried to chime in and say, I said, "Yeah, this isn't so good." And of course, there were all these trolls were like, "No, you don't know what you're talking about." I said, "Okay, fine." And then like 6 months later, people start coming back and they're like, "I've been using this and I've been losing money and everything seems to fall apart." And I didn't say I told you so, but that was exactly it. So that's like
Do they still
another.
have that? Do
Yeah, they
they just?
do. And
Right.
it's not just TradeStation, other software, they all have some variation of that. And I'm not saying you can't find some value with it, but the way most people use it is they see that what I'd call a sweet spot. "Oh, I've got to use these values." And then they go and run with it. But again, it's because the sweet spot values were determined on all the data. That's just an optimized backtest. So now all that out of sample data that you ran with the walk forward test is not really out of sample. So those are just two things. There's a lot of other real subtle things that I do that just don't have time to get into, and that most people, they'd be like, "I don't even know what he's talking about."
Yeah.
It's one of those things where you have to get into the weeds of walk forward testing, and then there's a lot of best practices, though,
Yes.
definitely.
Is that the kind of stuff you would cover in your workshop?
Yeah, I definitely do. And, my workshop covers it. And the other part of it is my workshop's a pretty boutique, small type thing. I don't have thousands of students, and, my workshops run by me. The support is done by me. I
Not the
don't have this
support team.
team. Yeah, I am the support team. So, as my wife says, "You're always on your computer." And I'm like, "Well, hey, I got people overseas who need answers at 10 o'clock at night
Crazy
or 3
hours.
o'clock yeah." But um, that that's good for getting some of those real little subtle points where you know obviously I the material I give is pretty comprehensive, but still people come up with questions of like, "What about this?" And um, that's what I'm there for, to help with some of those real little subtle things.
So, just while we're on the topic of TradeStation's technology for walk forward and so on, what's your tech stack look like? What tools have you had to use, implement, create to do your robustness testing properly, and I'm particularly interested in this coming into futures. I talked about this with Bob Pardo. I feel like the tools that I've got access to for just kind of more regular equities trading um, are a lot more comprehensive and allow me to do all the things that I want to do. Whereas TradeStation's been around for a long time. A lot of people complain about it. And then, there's when you're trading these short-term future strategies, there's a big step between building the strategies and creating a portfolio. So I want to get into that quickly next if we can. But just first, I guess, what's your tech stack look like, and how hard is it to build out the right stack to do all of this properly, from A to Z, or Z, if you like?
So, TradeStation, I do a lot of the testing with, and I've done that for years and years. A lot of the portfolio type thing, the Monte Carlo simulation, a lot of those tools I've developed in Excel, and a lot of that was by necessity. It was just things that I thought I needed that just didn't exist commercially. Now, years later, there are a lot more commercial tools, especially like portfolio building tools, and there's a lot of people doing third party stuff. So TradeStation, Excel, and the other big tool I use is a tool called Multi-Walk, which allows me to do walk forward testing the way I think it should be done. And the reason I know it meets what I like is because it was actually written by a course student of mine who is a computer programmer. He took my course like 8 years ago and said, "Wow, this is great. I'm developing strategies, but it's kind of a lot of it's manual, and it'd be much nicer if I could test faster and automate some of this." And so he took it upon himself to actually create a tool that works just with TradeStation. I wish it worked with everything, but it gets to TradeStation's what I'd call their side door for optimization, and it takes their optimization engine and uses it, and it will allow rapid testing, that's walk forward testing, on a variety of markets and different combinations of things, and you can do it a lot quicker. So the combination of TradeStation with this multi-walk tool and then doing things in Excel, that pretty much covers what I need to do. And I can't say what I do is like the optimum, the best way to do it. Because I know, like, for example, a lot of people use Python these days, and there's a lot of great stuff in Python. And maybe if I was starting today, I might go down that road more. But part of it's, hey, I've been doing it this way for so long, and I know the ins and outs of and advantages and disadvantages of each one of the tools I'm using. And that allows me to focus more just on building strategies, not necessarily just working on the tool part of it, because you could get bogged down easily in saying, well, I want a tool that will do all this for me. And you get away from the strategy building. I actually have, people contact me. A lot of them are computer programmers who their first thing is, I'm going to build a back test engine. And I'm always like, why? Why not use one of the retail platforms? Yeah, TradeStation's not perfect. Ninja's not. Multicharts. I could go any platform, even Python. You're going to have problems with it. And certainly if you went and tried to do all this yourself, you're going to have lots of problems. So I tend to stick with what I know, what works, and try to take advantage of all that and focus on the strategy part of it.
Yeah, I think that's really important. There's a lot of people coding out there and never coming to a knowledge of what it takes to really trade. You can really get lost down that rabbit hole.
Yeah.
If you are a coder, there's a certain advantage to being a trader first, I think.
Yep.
And then if you can code, that's great. On the walk forward, then, is one of the things that you like about it that it's a way of keeping in tune with the market. So once you've built the strategy, of course, walk forward implies that you've got a methodology for updating that strategy as you go forward.
Yes.
Is that really critical? Do you think that act of, quote, staying in tune with the markets?
I think there is benefit to it. It's not what I would call a night and day difference. So, because it depends on the strategy. There are some strategies I have that almost never change their parameters. Every time I re-optimize, nothing changes, and the strategy still chugs along. There's other strategies that change a lot all the time, and sometimes that works. And then, of course, you could say, "Oh, hey, I'm in tune to it," but you could also be out of tune, where your optimization says, "Oh, use this for a breakout length," and then the next period that becomes the worst thing to use, and you could constantly be chasing it. So you do have that sometimes where the strategy just you think it's in sync with the market, but it's really out of sync. Um, so I've seen all of those, but in general, I think the benefits of walk forward just outweigh some of the things that you can do when you don't use walk forward, and so then it becomes something that's worth doing.
Mm. So is there a way to distinguish between, what might be a fortunate walk forward result and genuine robustness?
um well
Are there some warning signs you look for?
again, that's what when you go and you do that 9-month real time test, that will help you. um the other thing, obviously, just if it looks too good to be true, that's usually a very good sign. And for people starting out, they don't know what looks too good to be true. But after a while, I'll look at an equity curve after doing it so many years. I look at an equity curve now and I'm like, yeah, that looks a little too good. And
Mm.
usually it is. Usually I've done something wrong, or, it falls apart in real time because I've over optimized, even though I try to really limit that. Um, so you can definitely see some things sometimes, but luck always plays a role. And the way I look at it is every single back test you have that looks good has some degree of luck built into it. You don't know how much necessarily,
Yeah.
but it has luck built into it. And chances are when you go live, that luck is either going to disappear at some point or right away, or it's going to, and then you have no luck, which, well, yeah, that wouldn't be too bad. Or it turns to bad luck, and and
Mm.
then your strategy kind of fails. So um, that's just the nature of it. Your back tests are always going to be somewhat optimistic, and you've got to kind of account for that. That's why one of the things, when you look at portfolios, a lot of people just take their back tested results and add them all up, and there's your
Mm.
portfolio. And, I've done that, and I know that's not the way to do it, because you take 10 good back tests, you add them together, you're going to get a great looking portfolio.
Yeah.
It doesn't mean it's going to happen going forward. And a lot of people don't get that.
Great. Well, that's a great lead into like the final section, if you like, where I'd love to talk about your portfolio construction process. So it's particularly relevant for the kind of trading that you do in intraday futures. So you're building lots of bespoke strategies, if you like, on different markets.
Yes.
How do you think about combining them into a portfolio? How do you kind of combine those back tests, if at all? How do you get a feel for, once you've combined 20, 30 strategies together, what to expect going forward in terms of compound annual growth rate or maximum drawdowns and this kind of thing?
So the way I do it, there's a couple steps to it. So one, you've got to start out with strategies that historically at least have not been too correlated. You want to make sure you get rid of ones that are just duplicates, more or less. Okay, so let's say you do that first. Then, as I mentioned earlier, I look at having so many strategies in each sector. And the question then becomes, well, if you can pick from 10 strategies, how do you know which two of the 10 do you pick on any given month? And so I've developed a process that I use that that seems to work, but it's also based on real-time data. So what I did was I went through, and for these 200 strategies, I make sure that I had 4 or 5 years of real-time results with those. And some of the strategies are doing good, some fail. It's a wide range, wide
Mm-hmm.
array, I should say, of different performing strategies, which is perfect because I wanted to come up with an algo, so to speak, of what worked and for a picking method and what didn't work. And again, that could become an optimization problem. So, for example, uh, a number of years ago, I looked at efficient frontier type portfolio uh, picking, where I'd try to get right on the sweet spot of the curve where you get the most return for a certain volatility or drawdown. And what ended up happening was I'd never hit that in the real world. It was always something off from it, and sometimes significantly off for it. So I got away from that. So I've tried different things over the years, and now I have something that I feel pretty comfortable with, that I've tested over 4 or 5 years, and it wasn't an optimized test. I basically said, uh, "Hey, this is what I think makes sense and what I think will work. Let's see how it works." And it was really a one-shot test again. I didn't want to try 10 different things and say, "Well, which one's the best? I'll do that," because that's just an optimization. Um, so I had to do, before I did that final test, I had to do a lot of, I guess, preliminary work to make sure I was going with my best guess at what was going to work. And I didn't really know. And even then, um, before I share it with students or even really commit to it on my own, I still wanted to run it in real time. And so I did that for a while before I felt comfortable enough with it. Because you never know. Everybody's created great back tests, whether they're portfolios, strategies, and watched it fall apart. And, that's always the fear. So the way I did that portfolio thing was trying to do a lot of thinking about what I wanted, what I could accept as a trader. And so the tough part about that is when you look at newer traders, they don't really know what they can accept as far as like drawdown. You know, my rule of thumb, just in talking to traders over the years, whatever drawdown you think you can handle, you
Mm-hmm.
can really handle about half of that. So I have
Mm-hmm.
people all the time who's, "Oh, I can handle 50% drawdown." I'm like, okay. And I know what will happen is when they get to about 20, 25%, they start to panic a little bit. Then they get to 30 and then panic a little more, 35, 40. Once they get over 40 to 45, that's usually when they pull the plug because they're
Right.
like, "I can't handle this." And
Yeah.
that's not a rip on them. It's just that's how they're made. Uh,
Mm.
you know, they thought they could handle 50%, or they thought they could handle 10% or
Well,
80%,
it's
whatever it
easy
is.
to handle the big drawdown when you're just looking at the back test on a piece of paper and you ran it in 3 seconds and you saw the
Yeah.
final outcome. Your emotions are very different, aren't they?
Right, right. When you've got to live with it in real time, um, it becomes painful. I used to track my equity every day, uh, and I remember I did it when the years I won the trading contest, and the one year where I finished in first place, had over 100% return for the year. I went back and looked, and I found out that I actually had a higher percentage of losing days than I did winning days. It was something like maybe 55% to 45%. So that meant right there, if you have 55% losing days, you're in drawdown at least that number of days, right?
Yeah.
But the big winning days would then bring me to a new equity high, and then I might have a whole bunch of down days, and then it might be another jump up. But uh, being able to live that and accept that is really hard. So a lot of the portfolio stuff that I do doesn't necessarily look at what the return is. It's more of the drawdowns and being able to handle both financially and mentally to handle those drawdowns that I expect.
So
And
how do you combine? So you're looking at trying to merge non-correlated strategies, presumably. Do you do you kind of update a back test? So I know we've talked before about your monthly process where at the end of each month you're looking at what's in the portfolio and you're reviewing it against your library of strategies that you've got sitting on the shelf and how they have been going, let's say, in a simulation environment. When you're looking at like combining your strategies into a portfolio, you're trying to merge non-correlated strategies. Are you running a back test on that whole portfolio to see what that looks like, or a Monte Carlo on that portfolio to sort of get a feel for how those strategies are all going to work together?
yeah, primarily what I'll do, since it changes month to month, I will run uh, Monte Carlo on, let's say I picked 25, 30 strategies. So I will get, say, those monthly results for each one, and I'll put that in a simulation to say, hey, how bad could it be?
Mm.
And try to get different levels. And then also, usually at the end of the month, I'll compare that. So you get a whole wide range of where you could be. I'll put what I actually got and how that compared to all those possibilities. And that also helps me understand how good my portfolio or strategy selection method for the portfolio, how good that actually is. Because you would think if you just randomly pick some of your strategies, you should be around the 50% mark for profit or drawdown, whatever you want to look at. And so I do look at that and say, well, am I picking better than a random, monkey throwing darts?
Mm.
And I've actually seen times where it would have been better just to randomly pick strategies than what I picked. And there's some months that are like that. And then there are other months where I'm doing maybe the 80th percentile of what I'd expect. So I do have that kind of feedback. But at the same time, I do look at what it could be the worst case. But I can tell you, just from a realistic point of view, is you tend to ignore that, you know.
Mm-hmm.
Well, if I trade this the next month, I could lose all this money. And most people, myself included, you never really say, oh, I got to make sure I don't hit that. Or, you tend to dismiss it, or, oh, that's
Yeah.
not going to happen. And then you run into months, like with all the stuff going on now, where, yeah, maybe it could happen.
I guess one of the things I'm getting at is, um, how do you avoid putting 20 strategies together that are all super highly correlated and are definitely going to all blow up in a month like the month we're having? Or has it just worked out that you can sort of, review the performance and of these strategies on a monthly basis? And because of the way you've built each individual one, you can you're keeping your sector allocation. We talked about
Mm-hmm.
that at the outset. So long as you're doing that, you can be fairly loose pants, if you like, with which strategies come in and out, and it's probably not going to have a hugely different impact on the portfolio as a whole.
Yeah, I think the sector part of it is a big deal, but at the same time, you do want to upfront make sure that historically these strategies, even if they're in different sectors and different style of strategies, uh, that they aren't correlated. So you want to make sure you're first eliminating those. So you want to start with something that at least historically the performance of all these strategies has not been correlated or highly
Right.
correlated. And obviously then you start, well, what's high correlation? And you get into all this, which becomes kind of tricky. But I think putting it in sectors does help. Now, that being said, um, events like the past week or 2 weeks, uh, stock market went down, interest rates where they were bouncing all over the place, energies went down. So sometimes things do become correlated, and there's almost no way to know in advance that your strategies are going to line up that way, and that's something you definitely just have to kind of, I don't want to say keep an eye on it because it makes it sound like I'm like, oh, you don't really have to worry about it, just watch out for it. But it does happen. So,
Yeah.
and
Okay.
some,
So the feeling I'm getting is that the whole build process is one that sort of you want to build robust strategies such that you can take various selections of them and combine them together and have a reasonable expectation about what's going to happen going forward. And if it was going to make a material difference, if you chose, these couple of strategies versus these couple, then you haven't really built the kind of robust strategies that you would want in your portfolio in the first place. You're sort of building strategies across a range of markets and sectors that are fairly homogeneous in a sense in what their risk is like and what their potential outcomes are, so that you can mix and match them, which means you have in a sense got this what we call loose pants approach, where your system's not so finely tuned that if you sub the wrong strategy in at the wrong month, the whole thing can fall apart. Like, it's got that
mhm.
robustness built into it. Is that a fair summary?
Yeah, I think that's a good way to describe it. And the thing I've noticed just from a practical point of view is that uh, you can, no matter how much time you spend trying to select the ideal ones, you're never gonna hit it. You're never even hitting 50% is not bad, which is random from all the strategies, but you're not going to consistently, or at least I haven't been able to hit 80 to the 90th percentile in performance by picking the right ones. There is so much randomness, just even in strategies that month to month, that, hey, the strategy doing great, and then all of a sudden it tanks the next month, and I'm like, wow, I hadn't seen that performance in 4 years, and then all of a sudden it loses a bunch of money. So um, yeah, it's tough.
So remind the listeners what you kind of do on a month by month basis. Like, what's the, just really quickly, I guess, what is the process that you're doing each month? Because you're, as we've said, you're subbing strategies in and out, which not
Mhm.
everyone necessarily works like that. So what does that
Right.
process look like at a high level?
Okay. So every month, the first thing I do at the end of every month is update all the performance of all the strategies. So like I said, I have around 200 or so. And then what I'll do is I'll look for ones that have been performing well. And some of that is actually backed up by data. Some of it's just psychological. Do I really want to trade this heating oil strategy that has lost money the last 18 months and lost a lot of money? Or do I want to trade this other heating oil strategy that has made money? in the same time period. Sort of common sense, but it's almost like a trend following of the strategy performance. So so I'll try to pick the ones, and I have a process for it, but pick the ones that have been doing better lately. And I'm looking both at return and I'm also looking at drawdown. And I'm trying to minimize my risk as much as I can. And so I have a process to do that. And so then I have a group. I whittle it down to how many I'm going to trade in each sector. And it might be, for example, I'm going to trade more ag strategies than I am stock indices. One, because I'm trying to balance it, but two, the stock indices are much more volatile, and I know I'm going to trade those with a smaller number of contracts. And so I have to have more ag strategies to kind of make up for that, where I'm trading bigger size with ags. So I try to balance that as much as I can with all the sectors. And ideally, 7 different markets or market sectors. It's 14.7%. I'd want to allocate 14.7% to each of those. It never quite comes out that way, but sometimes I get kind of close. And then I don't do it that much, but there's always what about one that doesn't even trade more than once a week? Should you trade that with bigger size? And there's so many different little things you can do. Again, I try to keep things simple, and I just say, okay, well, I'm just going to assume that I'm going to be using all the margin all the time, or a certain percentage of my margin. And even worst case, I'm not going to run into a margin call. Some people like margin calls because then they know, hey, I'm using all my available margin. I think it's crazy, but it depends how much leverage you want, and so everybody's different. So I have a certain number of strategies in each sector, and then I kind of go with it, and those are the ones I'm going to trade. And what I've noticed just in live trading, every month out of 20 to, let's just say, 25 strategies, normally 5 to 8 will change month to month, where most of them stay the same, but a few get swapped out. They come, and then new ones come in, and maybe the ones that got swapped out come back in a couple months later. And that's kind of how I approach it.
So the ones that come in because they're performing better, I take it you're not looking at like a very short window of performance, or you could be swapping things out because they had a bad month and they're just about to have a great month.
Right.
So you're looking at how those strategies have done over a longer period.
Yeah, like the last year or so. That seems to be a good number. You can also look at the last 6 months, but yeah, to your point, you don't want to necessarily look at just the last month of performance, because at least I know I have some strategies that tend to go up one month and then down the next, up, down, and obviously you'd be turning it on and off at the wrong time, so you got to watch out for that.
So I guess the big philosophical alternative to this process would be somebody who builds the 200 strategies, likes them all, says they're all robust, and runs them all, assuming they can get the sector allocation and so on, or maybe they choose the best 100.
Yep.
But it's like, assuming you've got the capital to do that, take all of those strategies because we've built them to be robust. So presumably they're designed to work in a fairly consistent fashion. So you take all of them and run them all would be the alternative.
Mm-hmm.
Have you, did you start like that and move over into this world of, I guess, allocating to the best performing strategies? It's kind of like trading the equity curve of those strategies, as you said. Is that something that you took on over time, or what have you seen that sort of tells you, or have you compared it to the other, and what are the pros and cons, I guess?
Yeah, so I used to trade a lot more as far as strategy. So I was somewhere in the 50 to 100 range. And that might have been even when I had less than 200 strategies I felt comfortable with. And I certainly know people who've traded 150, 200 strategies. Um, I found a couple things over time. One is to be diversified, and depending how you look at it, and this is one thing I have in the course, I have something I call the diversificator, which you basically add equity curve for strategies. You keep adding equity curves and you look at your kind of risk adjusted return. And what you find, if you trade one strategy, you're going to have a lot of risk. But if you trade two strategies, your risk comes down. And it's kind of like a almost like an exponential curve going down. And then once you get around, depending on your strategies, roughly around 20 to 30 strategies, the benefit of adding another strategy uh, to your overall risk performance, or your risk adjusted performance, isn't that great. And so when I saw that, that kind of played into, well, maybe I don't need to trade all these. The other part of that then was just the logistics of trading all those strategies.
Mm,
Um, when you're automating your trading, uh, there are always things that go wrong. Your internet goes out for 2 seconds, or something happens, and then all your charts refresh. But maybe they don't all because there's some kind of memory issue with the software, or there's all sorts of things that happen uh, where monitoring 50 strategies, it's not 50 times harder than monitoring one, but it is harder,
mm,
and you spend more time tracking down these, orphan fills and that kind of thing. So, uh, for my own trading, I kind of found what I thought was a sweet spot where, yeah, I think I'm pretty diversified and it's manageable, where I'm not stressed out, where, you've part of the rule for automated trading, per the exchange, is you've got to supervise your trading systems. You can't just let it run and come back a week later and see
mm.
how you did. Um, so you've got to put some time into monitoring these things. And, if you have 100 strategies, it is going to take you longer than monitoring 20 or 30.
Yeah.
So those were the two big things in my thinking that, uh, probably 10 years ago, I was probably trading 50 to 100. And now I've kind of come down more. Um,
But to the point as well, you've found that trading, let's say 20, um, the best results that you've had are by keeping in tune with trading the strategies that are performing well in recent history. Perhaps that's keeping you in tune with market updates. So you're willing to change those strategies on a fairly frequent basis, and that you've had better results doing that than picking the best 20 at date X and letting them go.
right, right.
Hmm.
So yeah, the one thing that reviewing everything every month does is it does allow you to jettison the ones that did perform bad. And I already know it's April 10th, but I already know I have some that I'm trading right now that I'm not going to be trading next month because they cost me
Hmm.
some money. And just
Hmm.
this first part of the month, unless they miraculously recover. But, that doesn't happen as much as the opposite. So,
Yeah.
yeah, it
But
kind
are
of
you
is.
also running the, sorry, Kevin, also running the walk forward analysis to update individual strategies along the way as well?
Yeah, so I actually, where is it? I have a sheet of, I'll just hold this up for people. You're not going to be able to see it, but there's probably about, 40 strategies here. These are the 40
Mm,
strategies that in the month of April, I've got to rerun the walk forward testing for. and they all have different dates going from the 1st to the 29th of the month. And but that's something I've got to do. I've got to update those. So that becomes part of the ongoing maintenance, which that's one of the drawbacks of having 200. I always have like 30 or 40 that I've got to reoptimize every month.
Well, we've chatted for a long time, actually, Kevin. So sorry to keep you so long, but it's been really educational. We can edit this out if you like, but can I ask at the apex of all of this, what kind of, because I'm not from that intraday futures world. I know that it's a great path to take if people want to get involved in proprietary or prop trading pods and whatnot. Like there's a lot of shops that will, for better or for worse, sponsor traders that generally are trading more that style than my style. But what kind of annual returns and drawdowns over the long term is this kind of trading geared toward finding in a best case scenario?
Well, if you look at the one benchmark I always use to compare with is what the pros are doing. And, there's websites, iasg.com. There's Barclay, I think it's called Barclays Hedge. It might be Barclay Hedge or Barclays Hedge, not affiliated with the bank. That's the confusing part. There's also a site, I haven't been there in a while, so I'm not even sure it's still around, called Autumn Gold. And what they do is they track commodity trading advisors, and they usually they have it broken up into like systematic traders, which would be an algo trader, and they give you performance and show you the best ones, the worst ones, all this returns, drawdowns. And what I've found by looking at that is it's hard to get above, say, 40% a year. 30 to 40% seems to be where a lot of they are the pros. And that isn't necessarily the best one. I look at like the 10th best. And the 10th best one is really fairly predictable year to year. And the drawdowns they usually have are about the same level. So over maybe the same period of time or a slightly bigger period of time. So what a lot of funds that I've looked at, they seem to be happy if they're doing 10% a year return. They can handle a 10% drawdown. That's 1-to-1. So if they want a 30% return, they've got to be able to handle a 30% drawdown. So for the retail trader, what I tell people is, hey, if you're doing that, you should consider yourself pretty good. For me personally, I like to do twice that. So my goals every year are 50% annual return with a 25% max drawdown. Some years I hit both. Some years, like last year, I hit the return part, but I was over on the drawdown a little bit. Some years I don't hit either of those goals. But that's the goal. That's what I'm shooting for. And kind of the way I build strategies support that. So, and that seems pretty reasonable to me. But you notice what I didn't say, it's, 200% return a year. That's what I expect. I don't say that because, yeah, I mean, that's possible. I mean, I've certainly done it, but I can tell you when I did it, even if my drawdown was low, even if my actual drawdown was low, my potential drawdown was probably 100%, especially when like I was trading those contests. You go all out and you're like, well, if I lose everything, that's what it encourages, max returns. And
that's
who cares?
why, and for those who don't know, Kevin's placed, I think, first once and second twice.
Twice, yeah. All 3 of those years were over 100% return, but I can tell you, I took a lot of risk. those
Yeah,
years.
and that's why Kevin, I didn't bother asking about those in this show, because we might err on the side of boring and we might lose some of our audience. But I'm drilling into what it takes to actually survive and be a real trader, and
Yeah.
and to trade over the long term. You need to have your your survivability has to be 100%, or your risk of ruin has to be 0%.
Right.
That's kind of the starting. That's the starting point, because you need to stay in the game if you're ever going to do the continual improvement that we talked about,
Yeah,
and you can
absolutely.
build from there.
Yeah, the trading a contest is a lot different than trading for uh, just long-term capital growth. Those are two different things. And the only thing they have in common are it goes back to your goals. And remember, I mentioned that earlier. So back when I won the trading contest, I had a goal where I said, uh, I'm designing a couple strategies that should get me 100% return a year. I did that specifically.
Yeah.
And I said, if I can get 100% a year, chances are I'll finish in the top 3. That was my goal. And I was able
Mm.
to do it. And I built a strategy around that whole premise. But now the way I trade, I don't build for 100%. I build for something that is definitely lower, but it's also less risk.
Mm.
And so again, it comes down to your goals. So now my goals are different. But that's where you got to start. And that's where I think a
Yeah.
lot of people, especially retail traders, get messed up is they're just aiming for the ultimate return without thinking about the risk or the long-term
Mm.
survivability. Because eventually the people who are going for hundreds of percent a year, sooner or later they're
Yeah.
going to get wiped out, almost
Well, you
guaranteed.
you mentioned Jim Simon's book, and we've had on the podcast Greg Zuckerman, who wrote that book, and they're the most successful algo quant trading fund of all time, right? And they averaged close to 70% if you include some recent years,
Yep.
and that is absolute world class. So, and you yourself are shooting for close to that, which is also world class. So, a couple of
Yeah, but
100% on any level of consistency is not really a realistic objective.
the just to clarify, the difference is that's what I'm aiming for, and
Yeah.
that isn't necessarily what I always get, or
Mm.
where the number you gave for Jim Simons, that's what they actually got. So
Mm.
I don't want people thinking, oh, Kevin says he's just as good as them,
Yeah. Yeah.
because I'm not, and I'm not
Yeah.
pretending to be. But
Yeah.
I aim high, but I think I have something that's realistic. But at the
Mm.
end of every year, I can say, yeah, I did it, or no, I didn't. Here's what I need to do to improve. But just the long term consistency of Renaissance is just amazing.
It's phenomenal. Yeah.
Yeah.
Well, you've been doing this for quite some time too, and you do have a few accolades, let's say. So, and you've got. I know people who have learned under you, and they've also done really, really well. So, um, congratulations on a long time at the markets. I know it's a lot of dedication and commitment.
Maybe stupidity too.
And Stu, I think that's for all of us, right? All of us in the markets.
Yeah, because you're
Definitely
like,
the
gosh,
case.
some of it is just staying in the game. Is
Mm,
there's a big value in that, just being able to do it long term, which a
yeah,
lot of people just give up. So
yeah, yeah. You got to have some tenacity.
yep.
Your logo in the background, Kevin, are they like 3 fighter jets
Yeah,
or
I
an?
think
Oh,
it was, and that kind of calls back to my aerospace
mm,
uh, history, and I'm not even sure. Uh, I don't even recall telling somebody that's what I wanted, but it goes up. That was the
it
thing I
goes
was
up.
looking for,
Well,
and
it's because you're a Top Gun, Kevin.
yeah,
Awesome, mate. It's been a real pleasure, and we've had a very lengthy chat. So people will be able to watch this twice and take notes and get a lot out of it. We've talked a lot about the strategy development and the robustness testing, and it's really great off the back of having talked to Bob Pardo and a compare and contrast to that.
Yeah.
Hopefully I'll continue this theme a little longer, grabbing another one of our mutual friends on the show if he'll come on, which I think he might. And it's really educational for me as well, because I'm looking forward to starting to move in this direction and add that to my trading. But it's there's a lot to do, and it doesn't happen overnight.
Yep.
Well, thanks once again. Definitely inspirational, and really appreciate your time, Kevin. So thank you.
Yeah. Well, thanks, Simon. I appreciate it. And, it's been a long talk, but it's just kind of flown by. So it didn't seem like doesn't seem like we were talking that long.
No. And we should quickly just not only let people know how they can get in contact with you, but I guess, do you want to give us a 1-minute summary on your workshop and what do people actually get out of that?
Oh, sure. So if you go to my website, kjtradingsystems.com, you can click under the workshop and you can learn about this workshop that I teach. So what it does is it helps you to develop strategies the way I develop strategies, which I think is the right way. So, just in my history, I've made tons of mistakes, did everything wrong I could possibly do wrong. And I've learned from those and incorporated that into what I teach. And so I help people avoid most of those pitfalls. Some of them you probably still have to learn on your own. That's human nature. But if you really follow what I'm doing, you'll be building strategies the way I do. And people have had success with it. And it's kind of like a beginning to end. I don't want to say it's for beginners, though. It's more for like intermediate traders, people who've been exposed, especially to futures markets. That's what I focus on. But it will work with Forex. It will work with stocks. I know some people who've done it with crypto. The general procedure is the same, but it really takes you from goals, what you want to do, to finish strategies. And that's basically what the course does. And once you learn how to build one strategy, then it becomes a matter of just building more and adding on. And that's the key, I think, is becoming a diversified algo trader, which you can't really do if you're doing discretionary chart trading. You can't be looking at 10 charts all the time, figuring out which to buy and sell. But if you have 10 different algos, you can kind of just monitor them, let them make the decisions. And I think it can become pretty powerful.
Yeah, indeed. Diversification. Well, that's a great note to sign off again on. So thanks once again, Kevin.
All right, thanks.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives. So nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.